Cash versus capital accounting. Suppose that the government borrows $2 million and spends it on two activities. One is a big party to celebrate the president's birthday, which costs $1 million. The second is a new office building for government executives, which also costs $1 million. When the government produces its budget at the end of the year, both of these expenditures will be reported identically, and the deficit will be $2 million bigger if there is no corresponding rise in taxes. Yet these expenditures are clearly not the same. In one case, the expenditure financed a fleeting pleasure. In the other, it financed a lasting capital asset, an investment with value not just for today, but for the future. Sidebar: Cash accounting, a method of measuring the government's fiscal position as the difference between current spending and current revenues. Capital accounting, a method of measuring the government's fiscal position that accounts for changes in the value of the government's net asset holdings. Returning to the text, this example points out a general concern with the government's use of cash accounting, a method of assessing the government's budgetary position that measures the deficit solely as the difference between current spending and current revenues. Some argue that instead, the appropriate means of assessing the government's budgetary position is to use capital accounting, which takes into account the change in the value of the government's net asset holdings. Under capital accounting, the government would set up a capital account that tracks investment expenditures, funds spent on long-term assets such as buildings and highways, separately from current consumption expenditures, funds spent on short-term items such as transfers to the unemployed. Within the capital account, the government would subtract investment expenditures and add the value of the asset purchased with this investment. For example, if the building built with the second $1 million had a market value of $1 million, then this expenditure would not change the government's capital account because the government would have simply shifted its assets from $1 million into cash into $1 million in buildings. See Figure 4-2, the comparison between standardized and cyclically adjusted and the actual budgets. The text reads actual versus cyclically adjusted versus standardized U.S. budget deficit. The cyclically adjusted budget deficit, which controls for the impacts of economic activity on the budget, showed a somewhat smaller deficit in the recessions of the early 1980s and the early 1990s, and a somewhat smaller surplus in the boom of the late 1990s. The standardized deficit, which also accounts for other short-term factors, showed even less movement over this period. Returning to the text, the absence of capital accounting gives a misleading picture of the government's financial position. In 1997, for example, the Clinton administration trumpeted its victory in proposing a balanced budget for the first time in 28 years. Little, little recognized in this fanfare that was that $36 billion of the revenues that would be raised to balance its budget came from one-time sales of a government asset, broadcast spectrum licenses, which allowed the provision of wireless services such as cell phones. The government was gaining the revenues from this sale, but at the same time it was selling off a valuable asset, the spectrum licenses. So the fiscal budget was balanced, but at the expense of lowering the value of the government's asset holdings. Problems